Before we dive into the video, a quick word from our sponsor, TradeStation. As tape readers, we rely heavily on TradeStation for their time and sales. TradeStation offers ATC students an account representative, zero commission, and a cash reward with qualifying deposits. Now back to the video.
This conference will now be recorded.
Hello and welcome everyone to the 8th ATC Tape Reading Podcast. My name is David Torres and I've been a longtime student with ATC. A couple announcements before we get started is we have review sessions every weekday at 8 p.m. Eastern Standard Time, and that's open to anyone, not just our current students or members. So feel free to join that, and more information will be posted on Instagram and within our chat room. We still are figuring out logistics of live streaming, what that'll look like, so definitely stay tuned for Instagram for that update as well. With that taken care of, it's my pleasure to introduce Rich Lepis, CEO and head instructor of Ahead of the Charts. Rich, how are we doing?
What's going on, Dave?
An interesting day in the markets, to say the least, right?
There's no question there. Well, not only in the markets, but an interesting day in the world.
Right, no question there. There's a lot of geopolitical news going on. I mean, in the markets, all across, not just, the US stock markets everywhere, also, feeling the hit. So
we were talking about it before. This is, something we haven't seen since pretty much World War II.
Yeah. I know, the younger generation as well, really, this is the first for them.
Mm-hmm.
So I kind of want to talk about how do we go about tape reading when we get big events like this? Because my perspective, we were talking about this beforehand, was, last night I was sitting there, I was like, this is a big news. There's going to be a lot of moves in the market, a lot of volatility. Things are going to be a lot more clear. It's going to be a lot of selling, panic. It's just going to be a beautiful trading day. I'm going to get in. My entries are just going to get further away from where they need to be. But I was, very wrong with that.
Trading day.
Yeah, I just perceived that, havoc would create perfect, trading day, but I was far from accurate.
Mm-hmm.
We saw a ton of prints that just, we couldn't make use of.
Yeah, there was a lot of, and the way that, I would explain is indecision.
Mm-hmm.
There wasn't anyone that was really coming out there that says, I know exactly what's going to happen from this, so this is what I'm going to do. So, I hate to bring this up, but it's one of the biggest things that happened in the beginning of my trading career was Sandy Hook. The terrible event that happened, the school shooting and stuff like that. But at that point, there was stocks to be focused on. There was, and Smith and Wesson was one of the big ones, and I still remember to this day seeing it come up on MSNBC. I was sitting in an office, and they had this big TV that was in front, and I remember seeing it come up on MSNBC, and there was calculations that everyone knew that they were going to try to restrict gun laws. Everyone there was things that you could almost interpret definitively out of that type of news. And again, I'm not saying that, but unfortunately, news is opportunity, and that's kind of the same mindset that you had coming into this morning. But really, what precedent is behind something like this, where you can specifically say this is going to happen to the equities market?
Right. So, the indecision was seen throughout the whole market this morning, and even still to this point. So with that indecision,
it's almost like everyone's sitting on their hands.
Yeah.
Because, if you're talking about futures, you're talking about Forex, there's certain things that you can almost interpret throughout that. But in a certain way, like, how does this affect Apple? How does this affect, just any type of blue chip stock, or really any stock? And you saw that this morning, where there just was nothing, no one really knew anything. And the people that did know stuff, they did it yesterday. So coming into this morning, you could tell that there a lot of people were just waiting for some type of interview or some type of speech or something is really just sitting on your hands. And you asked a great question, is how do you go about when it's like that? How do you trade? And the answer is, well, I follow people for a living. That's what a tape reader does, is we see buying and selling, we see the supply and demand, and we make all of our decisions based off of that. And when there's no real supplier demand, and when I say real, there was plenty of prints that were going off, but no real buying or selling, just straight up, this is what's happening. Unfortunately, you just really can't trade. I did a coaching session this morning with one of our students, Steve.
Oh, wow.
And we were sitting there the whole time, and everything that we saw, I saw some prints here, I'd see some prints there, but they were all mixed within this, this nonsense of with purple and yellow. We call them the Lakers colors, but above the ask and below the bid. And there just wasn't anyone that was definitively there. There was not one real trade that could be made.
Yeah, no, I went and I proceeded this morning, try to trade this market like it was a normal day, but I quickly found out that was the wrong approach. And I
You found
look,
out that personality is completely
yeah,
different.
I took one shake and I was like, yep, that one shake can tell me enough for the rest of the day.
Yep. Especially you take that one shake in one stock and you look over at your scanning screen and everything's just purple and yellow. There's no real prints there. You adjust very quickly.
Yeah, no, I definitely adjusted. I was just, I don't know. It was bringing those expectations of last night, all the news, into today, trying to find something. I look back now and I was like, I already had the mindset that I was going to trade something, but you know, looking back in hindsight, I should have really approached it as, okay, I need to truly find someone who's high percentage to follow, and they're showing they need to make money now, which we just didn't get.
And since you've known me, how many times have I brought up news?
Never. We don't
There's a
talk.
reason that I don't
Yeah,
go on my phone in the morning.
yeah, we don't talk about news. The thing with our community is we are the least news oriented community out there. We all we do is trade prints, and that's it. And that's what it comes down to.
I mean, to the point where I typically don't even know the market's going to be closed until like the day before because
That
it's
that
just,
is true. That is true.
we live as a tape reader, we live in this different world
Hmm.
where our world is controlled. If we get the prints, we get the prints. If we don't get the prints, we don't. So when you try to take into account anything else that's going on, it's above our pay grade. Let
Yeah,
someone else figure that out and then show us, and from there we can trade.
yeah. For lack of better words, my expectations don't mean shit when it comes to the
There
market.
you go.
The prints will tell you whether you can take a high percentage trade or not, and that's the mindset we as tape readers need to cultivate. No question there.
Hmm.
So, just in terms of navigating that is just really just be patient with that. Then really just set your percentages of what you need to see even higher than what it would be, right?
So set your percentages higher, but it really comes down to the habit that you're building previous to days like this. Because on a
Mhm.
great day, anyone can trade.
Right.
But on days like this, it comes back to that habit of discipline. And when there's just nothing there, there's just nothing there. If you don't know, what are you supposed to do?
Yeah.
Now it becomes you wanting to trade rather than you following someone that's telling you this is an actual trade. And that's the opposite of anything that breeds consistency.
Well said. We can't make up things, we can't make up prints and expect them to do something. So that's
Mm.
very well said. Kind of transitioning from that more towards like a market structure perspective and thought process is matrix. Can you describe a little bit to us what the matrix is? How do we use the matrix in context of tape reading? And then maybe how we fully optimize our ability to use and read the matrix in combination with the tape.
Okay, so in simple terms, the matrix, you could call it the order book because not, TradeStation's platform is going to be the matrix, but the NASDAQ book viewer, that's what I actually grew up trading on. And it
Mhm.
was $15 a month. It was a separate window that you had to open up and put it next to your platform. Very clunky. They ended up making it even bigger. But essentially what it is it's the buy and sell orders that have not been executed yet, but are put there for essentially the liquidity of the market. So if we look down the bid side, we can look at any price of that stock and see how many people already have sell orders sitting on that bid side. Just like we can look at the ask side. At each price, we can tell how many orders, and that essentially there are some orders behind those, but for the most part, we can see what the actual orders that people are willing to have out there to be executed. For instance, if the stock's at $5, 501 on the ask, there's 10,000 shares, I can buy 10,000 shares. It's showing me that there's 10,000 shares available. Someone's willing to sell those to me.
Mhm. And we could also see how many sellers or buyers are within that one order, right? So we can see like there's
Yeah.
five
So
versus.
on the matrix, you can also see that on a level 2. We can see that right in your background. Everyone sees the pretty rainbow colored
Yep.
boxes on the screen. So we can see yeah, exactly. So we can see it over there. Now, the amount of people in comparison to the actual order gives you a little bit of information, but it's also not that important because even if there's 5 people that are putting up a huge order out there, let's say 500,000 shares, that still means there's a huge amount of interest at that level. Compared to if there's only one person there, that 500,000 share order is a little bit stronger because it's one person, but it's still relatively going to do the exact same thing. So we can see the amount of people. It's just the effect that that extra information has really isn't that great.
So that just, it's not that, great of an impact on our trading if it's 1 or 5, really.
Exactly. Now, if there's 50 people and that's what's, creating such a big order, then that's a big difference. But how often are you going to see 50 people composing an order coming into one of the books? You just don't really see that.
Yeah, I don't think I've ever seen that.
No, me neither.
So kind of in that thought process, can they manipulate, the orders out there? Just, show them, pull them, can you break into maybe some tactics they can use to, really, I don't want to say manipulate, might be the wrong
Yeah,
word,
so
but
I do want to correct that word because have you ever put an order out there and canceled it?
I have, yes.
Yeah, we all have, right?
Yeah.
Either it could go by, it could. So it's not. We're just canceling it. That means that the order's not there anymore. So it's not manipulation because if it was manipulation, it would still look like the same order, even though that person got rid of it. It
Right.
shows exactly what they're doing. Okay. So I'm going to talk about the way with the matrix, the same way I talk about time and sales. The matrix, if everything just fits. So let's say, every level is like 2,000 shares, 3,000 shares, you have 1,500 here, 800 there, 2,500 there, and they all look relatively the same, doesn't mean anything for us. The same way that we read time and sales and we look for things to stand out, we look for something that is out of the ordinary from everything that we've seen happen throughout, the course of us actually watching that stock. That's when things become important. So it's when you have the 2,000, 2,500, 3,000, 1,500 all at every price level, but then you have somebody that all of a sudden has 110,000 shares out there. That's when we can start using it as information. Because like you said, at the end of the day, I could put any amount of shares I want out there for an order. I can cancel them whenever I feel like. I'm not manipulating. I'm just doing what I personally feel like doing, with my game plan and the way that I'm going to be trading. So the most important thing when you're looking at an order book is to understand you're looking for the same type of things that you would see in time and sales, prints that stick out, something that shows you, well, this person obviously has a game plan. And one of the great things about, about the market is that if someone has a 100,000 share order out there, more than likely they know what they're doing. Because if you're trading 100,000 shares just because you have money and you just keep losing, you're not going to have a lot of money for a long period of time. Eventually, you're just not going to be there anymore. And the people that have that much money, they're probably not sitting there just clicking buttons for the hell of it.
Right.
So we can almost always assume when we see something that stands out in the order book, it's going to be a market maker, 99.9% of the time. So what we want to do is we want to look for things that are just out of the ordinary. If it's trade, if the orders are thick and you see thousands, or thicker and you see thousands, but now it's into 100, you see a 100,000 share order, that's a really big deal. If the orders are in hundreds and you see a 30,000 share order, that's a really big deal. One of the things that we want to look at is print personality as well when we're looking at the matrix for things to stand out. Because if there's, let's say the print personality, basically what that means is the average amount that we see a market maker go out there and take some type of execution, whether it be buying or selling. So, if on average, if when a market maker is doing something, it might be 4 prints, could be 2 prints, could be 5 prints, could be so on and so forth. So if your print personality is really low, even though it's only a 30,000 share order, which doesn't seem like a lot, look at your time and sales and think, how often are people printing bursts of 30,000 shares? So when that doesn't happen often, but you see it on the matrix, that's when it's time to start focusing on those things.
So it's all relative to its personality, right? Is what stands out.
Every single thing that we do is all relative. We use it depends.
Yeah.
Because it's relative to what the actual stock is. 30,000 shares on a stock could be a huge amount on one stock, and on another stock, it's not even, it's a drop in the bucket.
So, and you referenced it like viewing the matrix as, sort of kind of like the tape. And I'm kind of curious the psychological aspect of, how we're very focused on the tape and the psychology behind the tape and the market makers and who are following what they need to accomplish. But how do you translate that psychology into the matrix. Maybe say there's an order that is showing and it comes up to that level and it's pulled, or we come up to that level and it's consistent and refreshing. In those instances, are you assigning like psychology behind that?
No question. So let's use a few examples, like you just said. So a stock, let's say, I'm just making up numbers to make it easy. So the stock's at $5, okay, and it's 510. Okay, there's 100,000 share order sitting out there on the ask side of things. So essentially, an order on the ask is somebody that's looking to sell that amount of shares. So if they have a 100,000 share order and it comes up towards that 510 point and they pull it, what was that 510 actually being used for?
It's almost being used as
To hold it down, right?
yeah.
Because they're telling us, I want this order out there. You don't just put a 100,000 share order out there because you're bored.
Right.
That doesn't just happen. There's a reason behind every click and everything's calculated. So when we're coming to that 510, if they wanted to let it be, if they wanted to sell those shares, or somebody wanted to come out there and try to buy them, we would see it be executed. Versus when they pull it, basically the psychology behind that is they're telling us, I don't want these shares. I don't want to sell these shares yet. So I'm trying to hold the stock down. The only logical explanation for that and the psychology behind it is that they're looking to still build underneath that 510 spot. They want the stock to stay below there to build, to then let the stock continue on its way towards the upside. So even though it looks like a 100,000 share sell order, it really isn't, because they don't want it. They don't want to sell it. They're using it as almost as intimidation. If you any class, you could go out there and look at level 3, the order book, matrix, whatever you see. People think that, okay, you have a huge order on the ask side of things, it's going to be a resistance point. But that's not that. Most of the time, that's completely untrue. We can use another example where so the stock's at 5, we come to 510, it's got 100,000. Now they let it execute. So what's happening? Now you got to think about something. 100,000 shares, that's a lot of shares, right? Especially at once, to execute in a burst of shares. It's not going to just pop up as like a print line where it would just say 100,000 shares. It's going to pop up as a bunch of different ask bursts because someone has to initiate to buy that. But if you think about it, one of the main philosophies behind tape reading is that market makers have to be right. We have to be under that assumption at all times. So if that actually gets executed at 510, what is that telling me? Well, more than likely the stock was probably at 3. And I'm sitting here looking at my pad right now, and I'm drawing the chart as I'm saying this. Okay, but essentially what's happening is they had enough. Okay, they had enough shares to build to a certain point. Now they're getting to that 510. More than likely, they're selling it to themselves. And what they're doing is they're exchanging their inventory for a higher price. Because if all market makers are right, if one person thinks the stock's going to go down, one person thinks it's going to go up, essentially one person's going to have to lose, aren't they?
Right.
But that's not really what's happening. What they're doing is they're adjusting their inventory to a higher price. Now we go to the psychology of that. What's the only reason to lock in profit and continue? It's almost like rolling over an option. Why are they rolling over their trade to a higher price? What are their expectations of that stock now?
So they're locking in the profit they already have, right? And they expect it eventually to go higher, but they're just taking it as almost increments, just locking it in. There's no.
It's almost like locking in and taking a new entry all at the same time.
Yeah, why not? If you're up a certain percentage on it, why not? It's not real gains until it's realized, right? So why as well lock those in if it's a big, Goldman Sachs or whatever, locking in for investors, and then from there proceeding to have a new position.
And especially when they're locking in and at that higher, that much higher of a price, it's telling us that the time frame, we have an extended time frame, not only for the trade to actually continue up when it's ready to go up, because obviously, other prints are going to come into this to tell us if it's a now time, we need a trigger, just basically how to trade. But that time frame is telling us not only is it a bit, if they're readjusting, they're telling us that the time frame over that they're going to have to start building again at that point. So it's the time frame that's going to take is going to take a little bit longer to get to where it needs to be. But the longer it takes to where it needs to be, it's also telling us the bigger the move.
Right.
We're looking for a more extended move because most market makers aren't going to go out there and execute a giant order or readjust inventory for 20 cents.
So
I can almost go to, no market maker is going to do that.
So is there different scales of refreshing in this instant? Because it could be, maybe a smaller amount of refresh, or it could be just an insane amount of refreshing where it's just
So
so
that
obvious.
technically wouldn't be refreshing though, because of the fact that that order was there.
Hmm.
So if there's a 100,000 share order and someone executes 100,000 shares, that's not refreshing. Now, if
Right.
they executed 90 and now it went back to 100, and then it
Uh-huh.
went back to 100, it went back to 100, that would be a refreshing point.
Okay. And there's different scales of that, right? So that adjusts our expectations for the pullback. So if it's just absurd amount of they're doing it over a longer period of time. Maybe it's over an hour that they're refreshing, coming at that level, hitting it, refreshing, pulling back small, coming back, hitting it again, refreshing, pulling back small. How do we adjust our expectations of, that building period in terms of how long they refresh or how large they refresh?
So the larger the rule of thumb is going to be, the more that they're refreshing, the bigger the move's going to be, the longer it's going to take.
Mm,
Because if they're refreshing, it all comes down to the tip of the iceberg. What we actually see isn't everything. There's a behind the scenes that goes on that we're not privy to.
right.
Okay, we don't work it unless you work at Goldman Sachs and you're looking at the guy next to you at his desk. We just don't see a lot. So what we see is actually is a small portion of what the overall is going to be. So if they show us huge refreshing, our pullback, we can assume is going to be bigger because the move itself has to be bigger.
Mhm.
And the bigger the move has to be, the more that they need to build. The more they need to build, the longer it's going to take. Again, everything's relative
Right.
to that specific stock, but that's our rule of thumb. That's the baseline that we're going to start at.
And coming from a like the retail psychology and retail mindset, they see that, they're like, oh, if they are looking at the tape, which is very few of them, right? They're sitting there and they're thinking, okay, this, this level's been hit so many times, it's got to break out soon, right?
Mhm.
So if it's that level 510, they keep hitting it over at 510 and the tape, and they're looking at it, they're just like, look how much buying is coming in at 510. We're definitely going to go higher. I'm taking this breakout. So that's the retail mind that even looks at the tape perspective.
Oh, 100%. There's no question.
And the market makers, I'm assuming, I'm almost sure that they understand that as well. So they use that to their advantage. So maybe even possibly, break out above that 510 and then continue to build.
Guaranteed. That's why
Yeah.
a lot of times you'll see refreshing and you'll see a quick move up first. So instead of getting that larger, like even if you see a ton of refreshing, instead of getting that large pullback that happens instantaneous,
Mhm.
exactly like what you said, they'll bring it above that 510 level to get a bunch of people that are real interested in it to then bring it all the way back. Because you got to think again, it comes back to the tip of the iceberg. If they're showing
Mhm.
us that much refreshing, that they're telling us that they need a lot of people's money to take in order for them to actually release the stock to be able to move. And I do apologize. It is my Discord. I don't know how to shut it off on.
No worries, no worries. And
Okay,
it's
well, I'll fix that for you.
situational too, right? Because say we, push up to a level, say level's 8, we push up to 8, we get aspirants of above prem personality indicating the market makers are looking to build, and then say we go to 820 above, and then they start refreshing over and over and over again, and say we're in that trade. How do we approach that? So the market maker's already telling us they need to build at 8, and then the 820 is refreshing, and it's evident to us. At that point, our long trade is coming to an end, correct?
So there's also some, technically, yes. It's also, again, it's going to depend on the amount of actual refreshing
Hmm.
because there's refreshing that you're going to see that happens pretty quickly, a couple times. And then that is really just a real small pullback. And then let's go, off to the races versus, seeing someone really using that refreshing to either build or change their inventory. So it's really going to depend. Now, one thing that you want to keep an eye on too is that there's certain stocks at every level is going to refresh.
Hmm.
And when something happens quite often, it starts to become irrelevant.
Hmm.
So you'll have a stock where it might refresh at 505, then 510, then 515, then 520. Usually you're going to see that like a 0 or 5 every, more often, than not. But you will see every once in a while like an off level, like, a 0.1, 2, 01, 02, 03, 04, so on and so forth. But when something happens way too often, it now takes our percentages of understanding the psychology away from it. So
Hmm.
when we see something constantly refreshing, it really doesn't give us any info anymore. What we want to do is we want to see someone go to a certain spot and then refresh. And from there, now we can see what their actual game plan, what their psychology behind it's going to be. Because if they're refreshing at every level, then it's relative. That
Yeah.
means nothing anymore. Because that's just what they're doing at every single level. It's the way the stock is trading rather than identifying an actual trader behind what's happening.
So it's almost a new normal for them is when they're refreshing consistently within it. It's not something that stands out because refreshing is supposed to stand out regardless. It's not
That's
something.
the thing. So if something happens every single level, it doesn't stand out anymore because that's just what's going on. Now we need to use our prints, we need to use everything else that we do for our trading. But what we really want to do to use refreshing for our benefit, we want to see somebody do it at a certain level. 730 in INDO comes to mind because not only did they refresh at 730, but they gave big ass prints at 730. We're going back days ago.
Mhm.
But that stands out because it was that exact spot. They didn't do it at 732 and 733 and 735. They did it at this exact spot. And if you go back to the chart the next day, got to 730, it started playing games. So we knew there was a market maker there that was ready for the stock to take off. But if we were in a long trade when we start to see that, it's not great because of the fact that we know that even when they're pushing it up, they're not ready yet. When a market maker says they need to build, that means they need to build. If they don't show us build, we don't have a high percentage trade. It's that simple.
Yeah, because how often do you see refreshing and then the stock just runs and it's just in money time and it runs another $5 from the refreshing?
I mean, with the way the market's been, in the pre-market, every once in a while you're going to see it, but maybe if you see, but that's what I mean. You guys, a lot of people they assign it as refreshing way too much because you really only see it a couple times a day.
Yeah.
It has to be someone that specifically is showing you something, and they're showing you what their game plan is without actually showing you, because 90% of people aren't looking at the tape, probably more than 90% of people. So they
Yeah.
have no idea how to look at it. And an order book, there's more people that have an order book than they do have a time and sales. But you need both of them to even understand what refreshing is going to be. So most people aren't even going to see that. So the reason that it's such a great tool to use for the psychology behind what they're doing is because they can do it freely because no one actually has the ability, no retail really has the ability to sit
Yeah.
there and see what they're doing.
No one, yeah, retail doesn't put two and two together, right?
No. Well, I mean, they don't have the 2 and 2 to put together.
Exactly.
Pretty much.
So kind of transitioning from that, I feel like we definitely hit as much as possible in terms of the matrix without using live examples, right? I feel like obviously that'll be the biggest takeaway as if you have a live, even recording of something that's refreshing will always be the biggest takeaway. But talking about it in theory as well definitely, brings new light to it in terms of, coming to the stock market and looking for it. So kind of transitioning from there, I've noticed one of the biggest questions as of late in our Traders Exchange, which is our weekly live meetings, which Rich holds, and he used live examples to answer our questions. And our nightly reviews is people just struggle with timing. It feels like they come up with a million different type of questions to ask the same question, and it's all coming down to timing because they know what the 1 through 4 trades are, what the market makers' intentions are overall, but it always comes back to timing. So I kind of wanted to get maybe a little insight from you is what were your biggest tips with timing as you were progressing, maybe in your early stages of tape reading? What'd you do? Was it maybe possibly journaling? Maybe it was, different tactics to really get better at timing? Maybe he's letting it get farther away from where it needs to be. Is there anything that comes to mind initially when it comes to timing?
So there's two things. The number one thing, and I say this all the time, if you want your percentage to be higher, let the stock get far away from where it needs to be before you look for a trade, because a trigger is what tells us that it's time to actually trade. That's when the market maker is enticing people to get in to actually help them make money, whether it be to help them build or to make money, depending if it's going against the prints or if it's going towards the prints based off of the prints themselves. But one of the biggest things that I did is that I waited for spots that logically made sense.
Hmm.
The thing is that, and I say this all the time, it's the curse of tape reading. You see great prints and you know what the stock needs to do overall. One day, could be tomorrow, could be 30 seconds, it could be obviously we have ways to figure out the timing on there, but that's what goes into our mind. So instead of letting a trade get to a spot that's perfect for us, what happens? Well, we have some aspirants at 5, it pulls back 10 cents. We don't want to miss out because we have that fear of missing that trade. And we get in on a trigger when it doesn't fit what the stock said it needs to do. So it's a combination. When we look for pull-ups and when we look for price targets, we have a specific calculation. If it doesn't hit that calculation, I know this was one of my biggest problems in the beginning too. If it doesn't hit that calculation, it's not a trade.
Mm.
So if the stock tells us it needs to pull back 50 cents, but pulls back 20 cents and it triggers, it's not a trigger. Just because it has price action and volume, it has nothing to do with what the market maker told us. So it comes back to being a good follower and understanding that this person said this needs to happen. So who am I to want the trade to happen quicker? Knowing the monetary amounts that it has to pull back to and or it has to go to, depending on the situation of the actual trade. And I see that so often, and especially in the nightly reviews, I hear people talking about their trades, and their trades are just based off, I know where it's eventually going to go. So it's not about the not knowing the timing, it's more about them wanting the timing to be right now. It's that lack of patience that comes in. I know right now, if I sat down and let's say my percentages were 30%, well, 30% is a really terrible percentage to have. You can actually still make money if you cut your losers and let your winners run, but it's still, you don't want to be in the 30% range. So at 30%, I have to understand, what am I doing wrong? So you said most people, almost everybody knows how I teach 1 through 4, right?
Mm-hmm.
So what does it come down to? It's not the market. It's not the market's fault for doing anything. The market does what it tells us it's going to do for the most part, to certain percentages. That's why we assign percentages to everything. So it really comes down to the person themselves. So I can tell you right now, if my percentage was 30%, I can make it 50% in one day just by letting the stock go 2 levels from a pullback to be able to allow myself to take the trade, then only going 1. Because if let's say the stock needs to pull back, and I'm going to use 5 as a number because it's just easy, easy thing to think in your head. So the stock is at 5, gets a bunch of ass prints that tell me it needs to pull back down to 450. Well, now in my mind, or most people's mind, if I'm only looking for it to pull back 50 cents, now 481, still take it, and they're still taking those trades, even though it's nowhere near the monetary amount it said it has to pull back from. So how about this? Okay, I'm going to miss a lot of trades by doing this. And when I say miss a lot of trades, it's not missing trades. I'm going to be taking a lot more high probability trades. But how about I have to have it come down to 4? Because if I know it needs to pull back 50 cents, but for me to actually take the trade, not only it has to go to 4 for me to actually take the trade, not only am I building discipline while I'm doing this, because now I'm going to be watching stocks that only pull back 50 cents and continue to go because that's what it said it needed to do. But not only am I going to be building that discipline, but I'm going to force myself not to start to cheat. Because the closer it gets to 450, the more psychologically we want to have an entry. And we stop looking at the fact of, is it an entry, and more to the fact of, I need to be in this trade the second it starts to move up.
Right. And I feel like from students' journals as well, you never hear a student say, I didn't take the trade because it didn't pull back enough from the monetary amount.
Never, right?
Never hear that.
Nope.
It's
That's
always
an excellent point.
Yeah, I took this, they don't say I didn't take it. They said, it didn't pull back enough, but I took it here.
Exactly.
Yeah.
It didn't pull back. See, think about that. And within trading, and this is a big problem for everyone. I know I'm that type of person. I'm always moving. I'm always, so yeah, I get antsy. So I know when it needs to come back to 450, the second it starts getting, 20 cents, now it's coming, at 480. I'm thinking like, okay, well now it's, it's almost game time. It's almost game time. And it causes your brain to start to anticipate a trade that's still not there yet.
Right.
So like I said, one of the best timing has so much to do with spots. So another thing that I would immediately do is that I would let the stock, if I'm at that 30% level, and I'm talking about 30% because if your timing's off, that means that you're going to have a shitty win percentage. I mean, it's that simple. So at 30%, not only am I going to let the stock start to get further away from where it needs to go, but I'm going to look for excellent spots. And what I mean by excellent spots is spots where I know that retail's money can be stolen. And what do I mean by this? Well, one of them, psychological number. Okay, the number 5. The second the stock goes over 5, retail is going to be interested in it because now I have support. Retail's always taught the first thing everyone knows is support and resistance. So at that point, I know that if it goes over 5, there's going to be a lot of people that come in. That's why you don't see how many stocks do you see go over a psych level and hold it forever. Now they almost always come back down first.
Yep.
Okay, so I'm going to be looking for spots that not necessarily that I have to read time and sales to know that actual retail got in there, because that can, if you have a high volume stock, that's almost impossible because you're constantly seeing retail go through it.
Mm-hmm.
So what can I do from there? I can use spots, support and resistance lines, consolidations, psychological numbers. I can look for spots. It was interesting. We did the night shift the other night, and somebody had boxes on their screen. But the boxes were set up as points where they thought games would happen, but they were in all the smooth spots. If a stock comes in, my entry is going to be coming out of a consolidation. More than likely, they already told me at that spot it's not the right time. So another big thing on timing is that look for, first of all, the monetary amount that it needs to pull back or go to, depending on what the prints are. But look for spots that the stock has proven to be smooth in. Okay, so if let's say it's not going to move $10, during that $10, there's going to be really lots of real nice trend lines, and then there's going to be consolidations and trends and consolidations, so on and so forth. Trading in those consolidations, I know for a fact market makers are in the consolidation. So getting almost, and that's one of the big things that kind of correlates with what I'm talking about right now, but getting in far away from where the stock needs to go, that means you're further away from a market maker. That means the less chance of when it shows you time, it not being the correct timing. So know where you are. If a stock's been in consolidation all day long and you're trying to trade out of that, well, even if it just had one large consolidation for an hour in the morning and now it's back around that same price range, and I try to take a trade out of that, more than likely it's not going to be correct. So I want to try to find those smooth stocks. I always say it, I'm a sucker for a smooth stock. And that's the reason behind it.
What's the psychology when it comes back to market makers playing games around their position? So I understand the whole concept, but get further away, because the further it gets away, the less games are in that area where further it gets away. So why is there more games in the area that they're most present or they have their largest position rather than farther away?
An excellent question. So we got to think about something. Well, market makers, when they're taking their positions, at the end of the day, what do they need? Big volume. So when they come in at those spots, it's because there's enough volume to actually be trading there. There's enough interest. There's enough shares. Excuse me. There's enough shares to actually take from people. So the further it gets away from there, there's less people to take from. The less people to take from, the more of a chance of them doing what they told you their original game plan is going to be. That's why trading, if the stock pushes over 50 and trying to hit the button, more than likely you're going to be wrong every time. I don't care what timing was. It's because of the fact they know who's going to be there. And to build as large positions as they do, they have to have that volume.
Yeah, it comes down to understanding high interest, points and levels, and you can just you have to expect those games there because it's the beauty of their work. It's just they show you exactly where they are and what the most volume is. So you have to expect the highest interest to be there and for them to accomplish their game plan there. So yeah, the further it gets away, the higher percentage your trade will be because the lack of retail interest in those areas where it gets farther away is not as high as it would be where the market maker is.
Yeah, well, I mean, it's almost like a self-fulfilling prophecy for the market makers is that, or even just a retail trader is that that's someone's sitting behind me every single time that I get into a trade. It's like they're sitting behind me and they know exactly. Yeah, because they're trading in those areas where they know the highest retail interest is going to be. If you're looking to build a large position, what do you need?
You need retail.
You need retail there.
And that's so
the
calculated
psychology behind it is very simple when you really think about it.
Yeah, no, and I mean, when you think about interest and just the perspective of interest, it's so calculated on their end, right? And we're trying to get in on an entry when in their highest interest level, and we're sitting there. Why did we get shaken out? We're frustrated. We're antsy or what have you. But if you look at it just from a sheer interest perspective, you're in their area where they need to do their job.
Exactly.
So
it's like if you saw somebody fixing the street and they got their jackhammers and they're going to the cop, would you just stand in the middle of them while they're trying to do their job?
no chance.
But it's really it translates to that exact same thing. That's what you're essentially doing. Like you said, they're trying to do their job, and you're trying to stand in the middle of them. Well, guess what? They're going to move you.
Yep. You're not, our
So,
positions are nothing to them.
yeah, of course. And so timing has a lot to do. It's not. It's There's a big correlation between the right areas and timing.
Mm,
Because there's certain areas it can look perfect. It's not going to be timed there. And you see that so often as trades being taken where, it's just that's not where the trade is. That's not where your highest probability is. Because guess what? Anytime a stock goes in a consolidation, if you're up $1, okay, how easy is it to understand the consolidation? Well, no big deal. But when you just took your trade and it's 3 cents in and now you're in a consolidation, well, things don't end up working out well.
you're watching every tick. Yeah.
Mhm.
No, that's a great, I think that summarizes a ton for timing. I feel like that'll really give our students and viewers a great indication and something to think about in journal moving forward. So, Rich, I appreciate having you on. It's always a pleasure. These podcasts just seem to always get better and better. So I appreciate your time and thank you for coming on.
Absolutely, Dave. You're doing a phenomenal job. I will talk to you next week.
Appreciate you, Rich.